Welcome back to Investing Talk Podcast. Today we're focusing on one of the real hot topics in the tech market right now, Nebius Group NV.
Yeah, this AI infrastructure company, well, it's seen some just unprecedented news flow, massive volatility lately, and it really brings us to the central question we found running through all our source material. Is now a good time to buy this stock? So our goal today is to, cut through some of that noise. We're going to analyze the fundamentals, the risks, and they are significant, and the market momentum, all based on the data and our sources. Hopefully this helps you, the listener, make a bit more sense of what's clearly a high-stakes situation. And hey, if you find this analysis helpful, please do remember to subscribe, like, and comment. Also, if there's a specific company you want us to look into next time, just drop us a comment below.
Okay, let's unpack this. Maybe start with the positive side first, the growth story. Looking just at the top line, I mean, the numbers are kind of staggering, aren't they? When you pull together the financials, what are those headline figures driving all this investor excitement?
Yeah, staggering is a good word. The performance really shows a company that's not just riding the AI wave, but aggressively capturing it. If we look at Q1 2025 revenue, it hit $55.3 million. Which, was already an incredible 385% jump year over year. Pretty impressive start.
385%, yeah. Okay.
But here's where it gets really interesting, the acceleration point. Q2 revenue surged to $105.1 million.
Wow.
Right. And that's not just a big number in itself. That figure represents a 625% year-on-year increase. And maybe even more telling, 106% sequential jump just from Q1 to Q2.
Whoa, okay, 106% quarter over quarter.
Exactly. This isn't like small, gradual growth. It feels more like a vertical takeoff.
625%. I mean, is that just growing from a really small base?
Yeah.
Or does it actually suggest they're taking serious market share?
Yeah.
Against the big guys like AWS or Azure?
Well, the sources lean towards the latter, mainly because of how the market and the company itself are signaling future capacity. Based on this really aggressive ramp-up, Nebius has significantly raised its annual recurring revenue guidance. They're now projecting somewhere between $900 million and $1.1 billion by the end of 2025.
From $105 million in Q2
Yeah.
to potentially over $1 billion run rate by year end.
That's the projection. And what's crucial, I think, is understanding that kind of leap. It suggests they're moving incredibly fast from maybe a startup scale towards being a core industrial supplier and in arguably the most demanding infrastructure niche right now, which is AI.
Okay, but that kind of transition, that speed.
Yeah.
It needs enormous amounts of capital, right? We know building massive AI infrastructure, getting the specialized hardware, securing the power, it's just eye-wateringly expensive. So where does the financial risk lie when you look beneath that shiny revenue growth? What are the costs here?
Yeah, and that really raises the single biggest question mark, sustainability. Because despite that huge revenue, the company is still deeply unprofitable. That's the key thing, capital intensity. For Q1 2025, the net loss from continuing operations was $113.6 million.
Okay.
And that loss actually got worse year over year by 41%. So they're essentially losing more money to make more money and doing it faster.
Right. So they've turbocharged the revenue engine, but the cash burn engine is running just as hot, maybe hotter.
Exactly. The core challenge is just the sheer amount of capital needed to actually support the contracts they're signing. The company has publicly stated a goal to secure over 1 gigawatt of power capacity by the end of 2026.
1 gigawatt, that's huge.
It is. For context, getting the power, developing the data center sites for that kind of capacity, it usually takes established hyperscalers years. Nebius is trying to compress that into roughly 18 months.
Okay, so that kind of speed demands constant cash injections, doesn't it? Aggressive financing.
Constant financing, yeah. And really careful liquidity management.
Did the sources get specific about how Nebius is tackling that immediate funding need? And what effect did that have on the existing shareholders?
They did. It's clear Nebius is being very aggressive in funding this build-out. Just this month, September 2025, they launched new offerings, convertible notes, and also Class A shares. And they stated explicitly it was to fund hardware buys and data center sites.
So directly for expansion.
Directly for expansion, yeah. Necessary to meet those contract demands, but it immediately brings in financing risk. And, maybe more critically for existing investors, concerns about shareholder dilution.
Right, and how did the market react to that?
Pretty much as you'd expect. The sources note that right after the announcement, the shares dropped by about 5.23%,
Okay.
which really shows investors are worried that this pace of growth means constantly going back to the market for more cash, potentially watering down existing stakes.
Okay, so you've got this constant cash burn, high capital needs, which brings us to the potential lifeline, I guess. The monumental news everyone's been talking about, the Microsoft contract. Did that deal, according to the sources, actually buy them enough financial breathing room, enough time? Or is it just adding a massive new layer of, well, execution risk?
Well, the analysis suggests it did both, actually. But its main short-term impact seems to be financial stabilization. This multi-year, multi-billion-dollar AI infrastructure deal they announced with Microsoft on September 8th. It's seen as transformative, and not just for the revenue numbers, but critically for their ability to finance everything else.
Also,
What's really crucial here, I mentioned in the sources, is that this specific agreement allows Nebius Group to secure new debt financing, and they can secure it specifically against the future cash flows guaranteed by that contract.
okay, so the contract itself becomes collateral.
Exactly. The moment they signed Microsoft, their capital structure arguably got much stronger because suddenly they have this high-quality, investment-grade counterparty basically guaranteeing future revenue. That makes getting other financing cheaper and easier.
It is a huge distinction. It's not just revenue, it's leverageable revenue.
Mm.
But the flip side, anchoring yourself to a client that big, that must create enormous concentration risk, right?
Yeah.
What other vulnerabilities does this contract introduce?
Oh, absolutely. It definitely creates concentration risk. That's probably the number one vulnerability highlighted. In the near term, their revenue growth is heavily, heavily dependent on this one single contract.
So anything goes wrong with the Microsoft relationship.
Or even just an interruption in execution, yeah. The whole financial thesis could wobble very quickly. And on top of that, the execution risk itself is incredibly high. Success hinges completely on them rapidly scaling up and reliably delivering their own proprietary hardware and software stack. And this stack has to be perfectly tuned for these really intensive AI workloads. There's very little room for error.
Can we just pause on that proprietary part? Why would Microsoft, they have Azure, their own massive cloud. Why partner with Nebius for capacity instead of just building more themselves? What's Nebius offering that's different?
So the sources suggest it really comes down to specialization. Nebius isn't selling generic cloud compute, right? They're focused on systems tuned specifically for the absolute most demanding tasks, like training huge generative AI models. Their proprietary stack, the hardware, the software, the networking, it's supposedly optimized for certain large language model training speeds in ways that perhaps more general-purpose cloud infrastructure struggles to match efficiently, both on cost and raw speed.
Okay, so it's like a high-performance niche within the broader cloud market?
Pretty much. They're selling premium performance for those cutting-edge AI jobs.
Got it. Okay, that reframes the competition a bit. Now, let's shift gears and maybe look at the technical side, the stock itself. For a listener who might be thinking about making a move now, what does the recent price action look like, especially after all this news, the financing, the Microsoft deal?
Yeah, well, the main word is still volatility. It remains pretty elevated, which, isn't surprising. Investors are clearly grappling with those dilution fears on one hand versus this potentially transformative contract on the other. Over the past couple of weeks, the stock seems to be consolidating a bit. It's mostly traded between, let's say, $93 and $102. It closed recently around $99.31.
So quite a tight range despite the huge news.
Exactly. And what's kind of fascinating is you see this clear support level forming around $95. That seems to be where buyers step in recently. And then there's resistance overhead near $105.
Okay.
This tight range, it sort of suggests a high-level debate playing out in the market. Big money is trying to figure out if the risk from that new dilution is fully baked in yet versus the fundamental support from landing Microsoft.
Right, like it's pausing before the next big move.
Could be. Seems like consolidation before the next major catalyst forces a direction.
And speaking of catalysts, what are those immediate events? The things that could actually force that next move? Given how sensitive this seems to be to cash flow and execution, what should investors really be watching closely in the short term?
Yeah, there are three pretty significant events coming up that could definitely shift the price. First, and probably most critical for checking if those huge projections are on track, Q3 2025 earnings, they're expected around October 23rd.
Okay, end of October. What will the market look for there?
Two main things, really. First, obviously, validating that revenue trajectory. Are they hitting the numbers? But maybe even more important this time, capital expenditure efficiency. Are they spending all that new money wisely, or is the burn rate getting out of control?
Right, the efficiency. Makes sense. What's second?
Second is actually an external market event. There's an ETF rebalancing coming up, focused specifically on AI infrastructure stocks, expected around November 10th.
Index funds.
Exactly. For a high volatility stock like Nebius, this can be really critical. Passive index funds, they'll be forced buyers or sellers based on the rebalance, regardless of the price at that moment. So that could really magnify volatility and liquidity shifts around that date.
Okay, good to know. And the third catalyst, back to funding.
Yep, funding. The third one is simply a potential update on their financing strategy. The company is constantly evaluating debt options, other funding strategies to speed up that infrastructure build even more. So any announcement about, say, securing new low-cost debt, maybe specifically tied to that Microsoft collateral we talked about,
Yep.
that could be seen as a strong positive signal about their financial health.
Right, showing they can leverage the deal effectively. Okay, let's try and bring this all together then. This feels like maybe the financial tightrope walk of the decade. You weigh these huge strengths, that explosive proprietary growth, the stabilizing Microsoft contract, against these massive cliffs, the operational risk, the deep losses, the execution dependency. What does the investment analysis from the sources ultimately suggest about that initial question? Is it a buy now situation?
Well, connecting all those dots, the kind of consensus view in the source material gives Nebius Group let's say, a rating rationale of about 7 out of 10 on the risk-reward scale.
7 out of 10. Good.
Which means, yeah, the upside potential is definitely there.
Yeah.
But the current share price seems to already factor in a lot of success. It assumes pretty substantial achievements, including basically flawless execution of that huge Microsoft deal.
So priced for near perfection already.
To some extent, yeah. And the sources tend to break down the investment approach based on risk tolerance and timeline. They suggest this stock might be best suited for short-term trading right now. You know, trying to ride the momentum swings around news events, capitalize on that high volatility.
And what about for someone looking longer term, someone wanting to hold this for, say, a few years?
For long-term investment, the sources frame it as a classic high-risk, high-reward play. It's much more speculative. Success there is entirely dependent on, well, everything going right. Smooth execution is paramount. They have to, like you said, run this marathon at a sprint pace. They need careful cost management, and critically, they absolutely have to hit that targeted path toward profitability, probably sometime in 2026 or beyond.
So no easy answer. It really comes down to the individual investor's own timeline and their comfort level with that very high operational leverage and execution risk.
Precisely. It depends heavily on your personal risk appetite.
Okay. Well, thank you for joining us for this closer look at Nebius Group NV. We've covered its almost unbelievable growth path, the really significant execution risks involved in building out infrastructure this fast, and how that pivotal Microsoft agreement acts as both, well, a crucial stabilizer, but also a major concentration risk.
Yeah, and we also noted there's persistent market speculation, kind of background chatter about two big possibilities. One is further geographic expansion, maybe specifically into the Asia-Pacific market soon. And the other is landing potentially other large generative AI customers before the end of this year, you know, diversifying beyond just Microsoft.
Right, reducing that dependency.
Exactly. Which leads us maybe to a final thought for you, the listener, to consider. While all the financial data right now points to this heavy dependency on the Microsoft deal, the big question is, can Nebius Group successfully use this current momentum, this window of opportunity? Can they leverage it to actually broaden their client base globally before that significant cash burn potentially becomes an insurmountable limiting factor?
A crucial question indeed. Thank you for listening to Investing Talk Podcast. We hope this analysis has provided some clarity on what is definitely a rapidly moving and very interesting stock.